What if I told you that you can use lifetime income that you get from an annuity and create an unlimited long-term care policy without buying insurance?
They have built in a feature that once you need long-term care, they will double that income stream.
Hey guys, we're back. What if I told you that you can use lifetime income that you get from an annuity and create an unlimited long-term care policy without buying insurance? Today I'm with Drew Nichols, co-founder of LTC Tree. Drew, how's it going today?
Hey, Derek, it's going well. Yep. So today we're going to talk about the topic you just introduced, and that is how you can get a lifetime long-term care benefit. There's a couple things we're going to cover in this video. One is there are some policies out there that will double an income coming off of an annuity for long-term care expenses in many cases. And secondly, you can use qualified funds. There's a lot of qualified funds out there in the world right now. This is a good way to lock in some to cover not only income, but long-term care. Let's get started.
Let's dive right into it. Yeah. So what an income annuity is you give a lump sum of money to an insurance company, and in turn, they'll give you a guaranteed lifetime income for life. So that just means as long as you live, they have to pay you X number of dollars. And the reason this is kind of come back into vogue, so to speak, is because interest rates are really at a 20-year high. And so these insurance companies will use that 10-year treasury to build these products mainly. And so now it's gone from 1%, from really 2008 to 2022 to 4 or 5%. They have a lot more of these that income to create these products. So there's policies out there that will guarantee you up to 10% simple guaranteed each year for the next 20 years. And at some point in between, you'll turn on a lifetime income stream. And then when you turn on that lifetime income stream, and in turn, it also creates guaranteed income that you can spend on anything you want, bills, care. And this video, we're talking about like how could you use it to pay for care? And what other aspects of these, Drew, do these policies have that relate to long-term care?
Well, a lot of them, and there are multiple options on the market. Depending on your particular situation, we're probably going to recommend two or three different ones. But the gist of it is we've kind of already covered the core is if you get the right lifetime annuity, they have built in a feature that typically after a 6-month wait, so there's a little bit of a wait, once you need long-term care, they will double that income stream. So like, let's just put some real world numbers on it. Let's say someone puts $200,000 into this annuity. They defer for a while and then begin taking a $40,000 a year income. Now, that would be many years into the future. They need long-term care. It's going to double that to 80K as long as there's a couple caveats. We should, it's not all rainbow and unicorns here. A couple caveats. They need to have the accumulated value still available to cover that doubling for long-term care. So maybe we can like dip into that just for a second. What exactly does that mean, the accumulated value?
That's a great question and an important question. So what the accumulated value is, you'll have two competing columns inside your equity index annuity with the lifetime income rider. One is the income base, and that income base is what's guaranteed. So if it's 8% compound guaranteed for 10 years, 10% simple guaranteed for 20 years, at some point you're going to turn on lifetime. You'll have an option to turn on lifetime income. And if you do, they have to pay you X number of dollars for the rest of your life. Now you can't get at that side of the equation lump sum. What the actual account value it means is inside the account, it's growing indexed to common indices such as the S&P 500, the Dow Jones, the NASDAQ. There's Fidelity, Barclays. There's a bunch of indexes that you can choose from. Now, there is a chance that those indexes never grow. So if it's 0% every single year, they still have to pay you the lifetime income, but your lump sum might not be possible. Now, odds are it's not going to be negative every year for 20 years. So whatever those indexes grow that lump sum, that's what's available to walk away lump sum. And in turn, you have to have money in there to get that doubler on the long-term care.
Yeah, so it wouldn't be a problem under most illustrations if you had recently turned on income. But let's say that that's grown to $500,000 on a $200,000 premium, and you've taken out that much in income, technically drawing it down. You might not get the doubler, but you'd still have the income. So, don't want to get lost in the weeds. I just like people to know that there are some caveats to these and understand what you're buying and buy from someone who can explain it. Because a lot of guys out there selling these, they don't even know how they work.
That's right. Yeah. And so a common way to trigger like this doubler, so it's basically a rider that you can add. You want the long-term care rider doubler added to you. And to trigger that, like you said earlier, I think 6 months have to pass, or you currently can't be needing care or living in a facility. What needing care means is needing help with your activities of daily living. So those are, usually the good way to remember them is the first things you do when you wake up in the morning. You get out of bed and you transfer the restroom. That's one. Take a shower. That's two. Bathing. Maybe get out of the shower and dress yourself. Dressing is three. Then after that, you go in the kitchen, get something to eat. Eating is four. Might use the restroom, that's five, and then maintain your continence throughout the day. So when your doctor certifies that you need help in is two of those six, that triggers that doubler. And so that doubler typically for the annuities we're looking at, it'll last for 5 years.
Right. So during that 5 year period, as long as you continue to need assistance with two out of those six activities of daily living, and you did a great job of kind of walking through them, as long as you still qualify, they're going to double that income. It's a great feature. And you know what I like the most about it? And this sounds too good to be true, but it is currently we have 300 some odd annuities in our software. And when we look at the top income annuities, they include this doubler rider. Literally, it costs nothing. I mean, there's no extra cost for it in the best annuities that provide the most income. So earlier today, before we made this video, Derek, we'll give him a little inside baseball. We were, kind of debating annuities versus bonds versus, buying a 30-year bond and holding it versus CDs and kind of trying to, for our clients' sake, put together all these different alternatives. None of the alternatives typically have a long-term care doubler like we're offering here.
That's right. Yeah. So it's a nice feature. And again, I've personally been doing this since 1999, and I've seen the evolution of the annuities. They were decent early 2000s, and they had a dark winter for 16 years where there just wasn't enough in that 10-year treasury for them to build these products to have features like that. But since it's kind of thought out and interest rates are more kind of at a historical norm, they've added things like that, and which can be really beneficial. And this type of product is for people, for a couple people, maybe somebody who doesn't have great health, because you do have to go through medical underwriting if you want long-term care insurance. But it's also for people who they have a concern, but at the same time, maybe they're a little bit higher net worth and they want the flexibility of this lifetime income that can be paid if they don't need long-term care. It's just cash money coming in that they can either go have fun with, go out to eat, travel, give to your grandkids, bank it, put it in your own bank account. And you don't have to worry about if you live to be 95, hey, what if I run out of money? Because you'll have this piece to always fall back on.
Yep. And again, we like to talk about the pros and cons of these things. Another con of this compared to like a pure long-term care policy is even with the doubler, there will be ordinary income taxes typically on that income coming off of the annuity. So, whereas a long-term care benefit's fully tax-free in most cases, and standard disclaimer applies, we're not tax advisors here. But with the annuity, you will have an income tax bill that comes along with it. So, just something to be aware of.
Yeah. And so, Drew, like, how can people fund these products?
Yeah, and that was one of the things we kind of hinted at in the beginning. Most of my clients are using qualified funds. So they're doing, transfers from their IRA, 401k, that kind of thing. And so they're able to defer the taxes, which is really nice. And, we've noticed there's a lot of money in with market trends the way they are right now at all-time highs. There's a lot of money in qualified funds. And frankly, and we've talked about this before, a lot of people should be taking a few chips off the table. If you're in your late 50s or 60s and you look at your portfolio and your 401k is 85% stocks, it would not be a bad idea to take a few percentage points out and put them in something more secure, whether it's what we're talking about or a bond fund or a CD or anything like that that's going to earn a return without the market risk. So
Yeah,
qualified funds is definitely number one, but it's not the only way.
yeah, that's a great point. Qualified funds, but also, there's been, you know, billions of dollars of annuities that were sold after the housing crisis in '08 to 2022 and they were sold when that Fed funds rate was 0.5%, 1%. So that in turn means there's a lot of older annuities in there. I'd say pre 2023, and really 2008 to 2023 that are probably could be refinanced into a much higher interest rates. And so we've run across dozens of clients this year who've called us. They watch our videos, they call us and say, "Hey, I got this old annuity that's, it's been paying me like 1.5% the past 5 years. Can you do anything for me?" Absolutely. And what you can do is you can do what is called a 1035 exchange. It means going from one annuity to the other annuity, and that process is tax free. And so basically, it's like refinancing a mortgage. If the interest rates fall, you want to get a low interest rate on the mortgage, you just refinance it into the new one. With annuities, if interest rates rise, you just refinance your low paying annuity into a high paying annuity. And that's kind of what we do is we help you compare all the annuities out there to see if we can get you more guaranteed interest.
I'd say there's one big difference, Derek. When you refinance your mortgage, it's like 35 signatures and pages, and you have to hire an attorney typically. This is much easier. In fact, we made a video. If someone's watching this on YouTube, go check it out. We made it a couple weeks ago. You had a client that you stumbled upon where you were able to dramatically improve their income situation by 15 minutes of their time and a couple signatures.
That's right. Yeah, it was the lady in Texas. They were making about $42,000 a year from an older annuity, guaranteed for life. And then we just did some paperwork, probably took no more than 15, 20 minutes. And now she's at 58,000 for the guaranteed for life. And so that's just how dramatic a shift that this interest rate market is really benefit the consumers if you're looking for a lifetime income annuity. And so, the last thing we wanted to just touch on is just kind of just recap of what we talked about. Drew, you want to take it from there?
Yeah, so there are some tax advantages. I mentioned that there's a tax implication. There actually are some annuity options that are what's called 7702 qualified. But long story short, you can use qualified funds, potentially get tax advantages, and you can double your lifetime income with a long-term care rider that's included at no cost on the top paying annuities right now. So, if you're looking at this and it's in 2025, early 2026, or beyond, give us a call and let's take a look at your situation because there's a lot of money that people are leaving on the table right now.
That's right. Yeah. So call us, visit our website, fill in the form, and we'll see if you can qualify and set you up with one of these plans and just put yourself in a better retirement situation. But either way, we appreciate you watching this tonight, and we'll be back for more. We do these every week.
Yep, we're
Thanks, guys.
LTC Tree, and we'll see you next time.